and welcome back to our video lecture for chapter 4, internal controls and cash. Now we're going to evaluate internal controls based on cash receipts and cash payments. So cash has its own specific internal controls, mainly because cash is very easy to steal, and most transactions, if not all, affect cash. So cash receipts, one cardinal rule is they should be deposited quickly. And as we talked about previously, we have the lockbox system where instead of sending cash payments to your place of business, they would go directly to a box, a P.O. box, in which the bank monitors and goes ahead and automatically deposits those. So and that's where cash received through the mail usually goes to this lockbox system. So basically when you have POS, point of sale terminals, right? That's what you see, mostly cash registers, right? That gives us some control over cash receipts because at the time that those goods are being scanned, that sale is being recorded, possibly the cost of good of the item, which we call cost of goods sold, is being recorded as well as the reduction to inventory. So the entries that are happening in this situation are debit, either cash or accounts receivable, depending on if it's a credit card payment or a cash payment, and then credit the sales revenue. And additionally, the debit to cost of goods sold and the credit to the inventory account for that sale. So those are the two entries that happen. And then the customer is given the receipts saying, here, this is proof, so this is your record, and now you can even get those receipts emailed. So then when that cashier takes the cash drawer at the end of the shift, all of that is reconciled similar to like a bank statement reconciliation. And then that gets reconciled to that cash drawer, to the cash receipts and the disbursements, and then you see that whole piece happening. So here, cash receipts by mail, this is where the segregation of duties comes in. And here, whoever gets the mail is different from who's giving it to the bank, who's also recording it, and who's also checking. So usually the person that gets it, possibly the treasurer, goes to the bank. Then the accounting department gets that deposit ticket, records it, and then here's the person that checks it, which is your controller, the checks and balances. So the checks are given to the treasurer, who in turn deposits it, who in turn gives it to the controller. The remittance advice are given to the accounting department. They record it, and then the controller checks that debit to cash. Now, for payments by checks or EFT, electronic funds transfer, that's another control because you record the payment. Then checks have to be usually signed by an official. And sometimes you need two signatories, meaning two people have to sign. So for example, you might be the controller and the CFO, or the CFO and the CEO have to sign all checks. Then the EFT must be approved also from a person. So for example, somebody would produce a batch and kind of issue, it's called a NACHA file. That NACHA file is the bank copy of, this is how the bank communicates to one another. So these are the people we want to pay, your vendors, and then possibly a controller or a CFO or someone else approves it. And then the evidence, don't get hung up, that evidence could be electronic or hard copy. And usually whatever you're paying, there's a three-way match when it comes to accounts payable. You usually have the purchase order, which basically says these are the goods we want to buy at how much. Then you have the shipping documents. Okay, we received the goods, they were in good condition. And then you have the invoice. And from that invoice is where you create the check. So that's your three-way match. Your purchase order, your shipping documents, and your invoice in turn let you issue the check when it comes to payments. So now you have controls over these purchases and payments. You can either email or fax purchase order. Email, I would say, is the most common now. Then you receive the goods, so that's the receiving report, or your shipping report, because that shows, yes, this was shipped and this is what you received. Then once you get the invoice, if they all agree, then you would go ahead and give out that check. So this is your purchase order, your inventory, and your invoice gets you the check. So it's a little bit different here because we have the purchase order. The receiving report, we would say, is 2, which includes what you received in inventory, and then 3 would be our invoice. So your book does it a little differently, but in industry, that's normally how we go about doing those pieces. So before you sign the check or you approve any electronic funds transfers, EFT, all the document is examined. So here's your purchase order, your receiving report, and your invoice to make sure they all agree and that the check is paying for truly what we said we were going to pay. So now let's move our attention to petty cash. And with petty cash, it's basically a small amount of actual cash that you have on hand. There's only one person that's responsible for it. And the amount ranges from $100 to $1,000. And basically what you do is you prepare a voucher or a receipt and for each payment. And then basically when you have the amount of money in the drawer plus what you paid, that should equal. So usually you use this for like maybe tips for people that come and bring flowers or come and bring food to the office, maybe some incidentals, you know, somebody had a baby, so you'll send them flowers and you'll do that through this fund. This is just for small little incidentals. So now let's move our attention to the cash budget. And so in this case, we have a budget, which is basically a financial plan, and it's to coordinate your business activities, similar to what you have in your home, right? So you have a budget, and this is how much money you make, and this is how much money your rent, utilities, and other expenses are. So you have a budget, so you know how much you can spend for other items. Well, a cash budget, in terms of a business, has these steps, because cash is king. Cash is one of the main items that we are constantly checking in business. And remember, working capital equals current assets minus current liability. And because of that, we're always checking cash. So usually as a controller or a CFO, you receive cash reports every day. So how we start with our cash budget is we go back to our T accounts for cash, we have beginning balance, we have cash receipts less cash payments equals our ending balance. So we have our budgeted receipts, we subtract our budgeted payments, and that gives us what cash is available before we need to finance. And normally you'll have a stipulated amount that says, hey, you need to have $70 million in our account because we are giving you a loan for $700 million, and we want to make sure you have 10% available. Banks will give you that. We call that a debt covenant or a cash restriction. So then once you know what you have available, and then you can pretty much compare that to what your budgeted cash balance is and see if you need any financing choices. So this you should have in Excel. This will help you not only on your homework, but it'll also help you on the exam. So here we have a cash budget where we start with the beginning balance and we're adding our cash receipts. So we have collections from customers, dividends on investments and stores. So basically we're taking these total right here to get our $69,150. Then we're taking our payments for inventory, expenses, expansion of the store, payments for long-term debt and dividend, and we are adding that balance. So this balance here adds up and gives us the $65,250. So if we take the $69,150 minus the $65,250, we get our $3,900. And then this amount is usually given, the budgeted cash balance that we need to have. So if we have $3,900, and we need to have $5,000, we don't have enough. So we need to actually get financing for that $1,100 that we're missing. The $3,900, and if we subtract the $5,000 that we need, we get a difference of $1,100. So actually make this Excel spreadsheet for your Excel for your exam template. And that will definitely help you with your exam. So let's go through an example. And so this would be a great example to use to start getting your Excel spreadsheet in order. So now we have this corporation that we have our cash budget. So we ended the year with $68 million. So that is going to be our beginning balance of cash. And basically we need to keep $70 million. So this $70 million of operations is going to be our budgeted cash balance as of December 31st, 2015. So we collected from customers $11,925, and then, so that's our collections. And then we paid for inventory $62.10, but we also expected to receive, so this is a collection, so this 15 million plus this 11,925 is showing our collections. And the rest of these amounts, the payment for inventory, operating expense payments, our investment in new equipment, this is a payment. Make sure you're aware of that. This is our payment because we're actually taking money and spending it in new equipment. We also have debt payments that we need to pay of $683. And here it says the company forecasts net income of $893. We don't need this amount at all, right? Because this is our forecast. That doesn't mean that we're actually making payments. So net income does not affect cash. So this is here just to confuse you, so don't let it. But we do have to take into consideration our dividend payments. So what it's asking us to do is to prepare a budget, and will the budgeted level of cash receipts leave the corporation with the desired ending balance of $70 million for operations? Well, and if they don't, how much do we need? So here we have our beginning balance. These were our cash receipts, right? So we have cash receipts from customers and our receipts. So basically these three amounts here equal our 12,008. Then our budgeted cash payments, we add all of these amounts here to get our 11,916. So we're purchasing inventory, we have operating expenses that we have to take care of. We're taking money and we're investing it in equipment. We're doing our debt and our dividends. So that gives us our 11,916. So we have cash available of 92 when we take our 12,008 minus our 11,916. That gives us our 92,000. There should be a formula in Excel. You take the 70 that we need, so we have an extra 22,000 on hand. So that is exactly, so you should have this in Excel, and that's exactly how you should do it. This number here should be a summation formula, and this number here should be a summation formula as well in your Excel. So, and then lastly, what we're going to cover, oh, what's going on here?